I have come here to chew bubblegum and kick ass, and I'm all out of bubblegum.
Hello, everyone, and welcome to a interview edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please don't hold that against me. Today, we have a very exciting guest with us. We have Andrei Polgar. Many of you may not have heard of Andrei because he's not a real estate guy. He is I'm going to go ahead and go on a limb here, Andrei, and say you are the creator, host, and all-around guy behind the channel 1 Minute Economics up on YouTube. Is that correct?
Yes, it is. Thank you for having me, Robert, and thank you, everyone, for listening.
Yeah, and this will be a great treat, I think, for the folks that listen. I have a pretty good following. I've had folks who've been with me all the way since the beginning, back when I started in 2007. But this is a unique one because the guests we've always had have been very real estate specific, with some sort of very specific real estate agenda to pitch. And I love the fact that I realize you have real estate holdings of your own, because what smart economics guy doesn't? Yep. But your focus is economics. Maybe you might want to give us a little bit of a breakdown about you, how you got into economics, and sort of your backstory a little bit.
Yeah, sure. I mean, as someone who lives in Romania and started out in Romania, kind of making it, quote unquote, on the internet was pretty much my only choice, because it's not like the offline opportunities over here are amazing. Mm-hmm. So I did. Actually, right from high school, I made quite a bit of money for someone in Romania. I've started a bunch of businesses, kind of like became an entrepreneur. That led me to getting to know a lot of smart people and kind of opened my eyes to exotic assets that I nowadays even specialize in. Mm-hmm. Like one of my biggest customers, who then traveled 2,000 miles to be the best man at my wedding, he was a professional domain name investor. And I was like, domain name what? Well, I invest in domains, he told me. And I started learning about that as well. I started, of course, moving on to cryptocurrencies as well. So the entire dimension of my life that has to do with entrepreneurship and investing and all that kind of made it clear to me that I'm good at anything that's money related. And being an economist was always a dream of mine, was always a passion of mine. And at the beginning of my career, unfortunately, since my mom got sick, I had to take her to get treatment abroad. My net worth evaporated and all that. I wasn't able to go to the university at which I was accepted. That was kind of awful. I had to put my dreams on hold for a while. But then once I started, being on my feet again, my businesses were going well, I was able to do the entire academics thing, from bachelor's to master's to PhD. I was able to do it from a position of relative financial comfort. So I do have this luxury on my channel, in my books, of saying, look, I don't rely on this particular income to pay the bills, so to speak. So I have this privilege of doing what I think thought leaders should be doing, mm-hmm. which is telling people what I think they should know rather than what I know they want to hear. And that kind of led me to 1 Minute Economics, to saying that I'm not happy with the manner in which economics is being taught. And this, along with the fact that I keep telling people that there's just no running away from economic decisions, you make them whether you realize it or not, this led me to deciding to try out posting a few videos as a bit of an experiment, the basic stuff, inflation, deflation, supply and demand. And much to my surprise, it turned out I was pretty good at making complicated stuff simple to understand. Sure. So people started liking my work. They started saying, hey, you should make some more videos. I moved on to even complicated things like explaining how the banking system works, fractional reserve banking, or talking about the famous or infamous derivatives, which to a large degree caused the Great Recession, or statistics related stuff and so on. And that led me to writing books, to working on my channel, and kind of to continuously trying to find the right balance between things that put food on the table, businesses, investing and whatnot, and things that give my professional life a deeper meaning, which is the work I do on the channel, which is the work I do when writing books. And it ended up working pretty well, I'd say.
Yeah, you actually kind of hit my radar about 11 months ago, a year ago, when you posted your extreme economic ideas and your intellectual comfort zones video. I was browsing through and I saw Ayn Rand on one side, Marx on the other. And
I love that.
I couldn't resist, of course. So had to listen to that, and I've been paying attention to you ever since then. So it was a surprise to me when you reached out via email, because I'm like, wow, here's a guy I've actually been listening to who is really good at sort of distilling things down to their essential bits and telling people about them. Now, of course, over the course of your description, we've used very unsexy terms. Because sadly, unsexy terms are the things that reach into your pocket and take your money. They are the things that make your house worth less or more. And the fact that you're able to sort of try to communicate those things in a way that's a lot more reasonable, I think a lot of folks are going to benefit from. And I'd encourage anyone who vaguely pays attention to my show to check out your channel, because I think it's a great place for folks to get that real quick. You don't have to sit down for 45 minutes. Like, for instance, I don't know if you checked out the Peter Schiff, Eric Voorhees Bitcoin debate that was posted by Reason TV the other day. But, that goes on for an hour and a half. And it's a great... Oh, yeah.
And actually, I did check out the debate on Bitcoin between Peter Schiff and Max Kaiser. It was as a part of a conference. I didn't see that one, actually.
It's actually I think it came out July 19th. It was posted July 19th, so just a couple of days ago. But, absolutely watched it. I got off on it because I'm a geek gearhead when it comes to this stuff. But I could see coming out of this hour and a half video, maybe a 1 minute video from you. But you've kind of already covered a lot of this in terms of your Bitcoin stuff. And I'm invested in Bitcoin, not heavily, just enough that I can say it and sound like I know what I'm doing. Do you have any thoughts on the part Bitcoin would play in a real estate world?
Yeah, as someone who's invested in crypto, like I'm invested in real estate, I'm invested in crypto. Like I work with 17 exchanges when it comes to crypto. Yeah. It may sound glamorous, but it's mostly because I don't trust any of them with my money, and I just like to keep a little bit in each to play it safe, kind of. So what I try to always tell people is that, the blockchain is not here to solve all your problems. It's here to give you options, plain and simple, when it comes to a few simple things. So yeah, I try my best to tell people that crypto is maybe even the biggest opportunity of our generation. So you do kind of owe it to yourself to at least research crypto a bit, to at least try to have a little bit of exposure, of course. And I try to make it clear in my book and whenever I talk to people about this stuff that it is definitely something that deserves to be a part of any balanced portfolio, much like real estate in a lot of cases. And this might very well work great for you guys if you take the time to do it, but it's only going to work if you understand what you're getting yourself into, because way too many investors don't realize that crypto is not what they want it to be. Crypto is what it is. They just see this huge money train that they want to hop on, and then they hop on, and if their timing isn't perfect, then they become shocked, like, oh my God, I cannot believe that back in December Bitcoin was at 20,000, and not so many weeks ago it was trading at 5,800. How can this be? And essentially you have investors who are surprised that Bitcoin is acting in the exact same manner in which it has been acting all along. Like in July of 2011, after famously going from $1 to $31 and crashing only to stabilize at $2, what many don't know, and you can actually find footage on YouTube by searching for 2011 Mt. Gox Bitcoin crash, before stabilizing at $2, it essentially went from 31 all the way to a few cents. It actually traded at a cent for a few moments. So if people want to crash, there it is. Then, of course, we have the whole situation that peaked in 2013. Then we have the one we're dealing with today. So essentially, this aggressive boom and bust cycle shouldn't surprise people. At least it shouldn't surprise people who got into crypto for all the right reasons. It shouldn't surprise people who got into crypto by understanding what these things actually are, how the market behaves, how humans, when it comes to anything from .com companies during the .com bubble to railway stocks in the United Kingdom in the 1800s or whatever else. We just tend to get a bit carried away when it comes to investing in technology-related things. And if you get involved in those assets and you do owe it to yourself to try to learn more about them, you need to do it right, in my opinion.
Yeah, and a lot of people make a disconnect between their perception of what it is and what it is, right? I mean, as a specific, I mean, we're talking cryptocurrencies are all of them, and you make a good point. I use the word Bitcoin in the same way I use Kleenex, right? It's I may have tissues not made by the Kleenex, the company that makes Kleenex, but Bitcoins are anything, right? The cryptocurrency is Bitcoin plus literally hundreds of others. But the point is, its intention is to be a currency, and a lot of people don't. I mean, I think maybe a lot of folks do, but there's a huge percentage of folks I encounter who aren't even really clear that that's what its point is. They don't really understand why it has value, or they don't understand the idea of technologically limited supplies and scarcity of that kind of level. I enjoy it because I'm a more of a libertarian kind of guy, so I love the idea of liberating the currency away from folks who want to manage it and let it be not managed. And in that way, I'm totally on board. But, I've got my own little questions in my head. Are you someone who thinks that, and I realize this has already happened, we've already had folks buy homes with Bitcoin. Do you see that becoming something that happens more often than using fiat currency?
More often than using fiat currency, I don't know, but I do consider it something that's going to become far, far more frequent.
Yeah.
And I mean, it's hard for me to explain this to folks who live in the US or Germany, but as someone who comes from Romania, and as someone who tried to do business in Romania back when PayPal didn't want to have anything to do with us. Now, we're nowadays in the European Union, things have changed a lot, but back when I started doing business, nobody wanted to have anything to do with Romania. So essentially, you might have had some great skills building websites or whatever it was you were capable of doing, but nobody wanted to facilitate the transaction dimension. So essentially, you had a very hard time getting paid. So just having this, you mentioned, the liberty aspect of it, the freedom that comes with using Bitcoin as this decentralized medium of exchange where nobody can ban you, nobody can say, oh, no, you're from this country, right, you're not allowed to use it. So just having this option, of course, it doesn't have to be the, end all, it doesn't have to be the ultimate solution, the only payment solution or whatever. It is, however, a very robust option. And you're right, like, people have gotten so caught up in the idea that, I don't even care what it's about. I just see that it's going up in value, sure, and I want a piece of the action, that they lost sight of the reason why crypto, Bitcoin in particular, has become huge in the first place. And of course, when prices start collapsing, they immediately say, oh yeah, Bitcoin is dead, crypto is dead, it's going to be gone forever. Once again, losing sight of the fact that there are core reasons why crypto is here to stay and deserves to stay. So I do try to push a far more balanced and rational approach when it comes to crypto, and not so much this pump and dump mentality that seems to be rampant in the industry. Yeah.
It's just outsiders who don't fully grok the whole thing, but just see the motion and kind of invest based on that. At least a lot of my friends who do it seems to be their thing.
Yeah. Same over here as well.
Yeah. All right. So we're going to take a quick break right now, but when we come back, I want to jump in and see if you can't give us some insights into what you think are some of the biggest economic issues that we'll be facing over the next year. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We are sitting down today with Andrei Polgar. He is the author, I guess, or creator of 1 Minute Economics up on YouTube. We've been talking with him now for a little while and talking some general economics. Now what I'd like to do is sort of tease out of your brain things you're willing to share with us that you see as the biggest financial issues that folks should be aware of for making good decisions over the next year.
when asking me about the things that I'm concerned about, a lot of people make the mistake of assuming that I am scared that I'm scared of a financial crash, and that's a huge mistake right there, because I'm an economist who likes to practice what he preaches. So, for example, when I talk about crypto, I talk from it not just because I've read about it, but also because I actively invest in crypto. I actively trade cryptocurrencies, even on leverage occasionally. So by being involved in industries as exotic as crypto or domain names and whatnot, I'm not exactly the type of economist who is easily spooked by the idea that, I don't know, maybe the stock market is going to crash by 60% or the real estate market or whatever. No, that's actually not what I'm afraid of. And this is where it becomes important, because what I am afraid of is a major change in narrative. So to kind of understand what I'm talking about, we need to see what the narrative has been up until this point. So we're going to take a step back and we're going to remember, okay, let's make it easy and start with the dot-com bubble, right? You had that bubble, it burst, people were panicking, and the narrative was simple. Don't worry, don't panic. Central banks and governments are here to save the day. And they have chosen to, quote unquote, save the day by, in the case of the Federal Reserve, lowering interest rates all the way from 6.5% to 1%, which may not seem like a big deal now, but it was huge back then. And once again, using quote unquote, it worked in that, okay, the economy was jump-started, but this was done at a price. And that price was inflating an even bigger bubble, the real estate bubble, which, as we know, popped in 2007 to 2008. Right. And once again, the narrative remained the same. Everyone was panicking, everyone was afraid, but don't worry, governments and central banks are here to save the day. There was just one problem. This time, the market demanded an even bigger dose of stimulus. Now, fortunately, interest rates had gotten a chance to get back up to 5.25%, so not all the way to 6.5, but not bad. So there was a safety cushion there, but still, the market said no. Lowering them to 1% wouldn't have been enough. So in the US, they were brought down to zero. In the European Union and Japan, they even went negative. And even that wasn't enough. Money had to be pumped directly into the system. In the United States, to the tune of $40 billion per month in mortgage-backed securities and $45 in treasury, so $85 billion per month. Multiply that by 12, and at the height of QE, we're talking about $1 trillion pumped into the economy each year. Now, guys, your third central bank, the Federal Reserve, appeared in 1913, and from 1913 up until the Great Recession, so in almost 100 years, the monetary base in the United States had reached $850 billion. So essentially, more money was pumped into the system in 1 year than had existed over a period of almost 100 years. And in the European Union, at the height of their QE, if you transform it in dollars, they actually printed more than the United quote unquote printed more than the United States. Over in Japan, it's just crazy as well. And what I'm trying to tell people is something simple. Okay, of course, we're going to have another crash. These things are cyclical in nature. It's been over 10 years since the last one. Only once has it happened that more time passed between recessions than right now. And if another year passes, it's going to be a record. So if you want to say so, we're due or overdue a recession from a cyclical perspective. So there's nothing special about it. It's just a business cycle. It's just the way things work. But of course, we're going to have our exogenous shock. We're going to have our stock market crash, real estate crash, you name it. People are going to panic. And governments and central banks are, of course, most likely going to push the same narrative, because if you're the head of a government or a central bank, it's your number one concern not to be that guy, the guy under whom it all collapsed. So you have every incentive in the world to try to push the can down the road, to kick the can down the road for another business cycle. The problem is this. One, as you know, in the United States, interest rates have not gone up spectacularly. And even though so much time has passed, and over in the European Union and Japan, things are much worse. So unfortunately, the safety cushion is just no longer there. And two, as mentioned with my previous examples, the market is most likely going to demand a bigger dose of stimulus. So for the sake of our discussion, we're going to say that, okay, we're going to have another crash. Once again, people are going to panic, and central banks are going to say, in the US, okay, we're going to lower interest rates to negative 1% and pump $3.5 trillion into the economy instead of 1. If the market says go for it, then we might be good to go for another business cycle. But what people need to understand is that things are already so crazy that a fair case can be made that sooner rather than later, the market is going to say no. And that no is what keeps me up at night, because that no means that a massive loss of confidence is going to take place. Yeah. Once again, as someone who has grown up in Romania, I've kind of gotten accustomed, involuntarily, of course, to the fact that systems don't always work. And perhaps more so than people from developed countries, I understood that society as we know it, with its many systems and institutions which are supposed to safeguard against one another, actually hangs on by a far thinner thread than we realize. And to a large degree, that thread is confidence, like confidence in the banking system. As mentioned on my YouTube channel, there's a fractional reserve system, and I cannot think of even one bank which would be able to survive if, I don't know, if 3 out of 10 people want their money back. The same way, the monetary system depends to a very large degree on confidence as well. And once that confidence is lost, all bets are off. I mean, of course, governments, central banks, institutions like the IMF, they have plans in place for such situations. Like the IMF is going to say, sure, if people lose confidence in the dollar and the euro and in the yen, we're just going to try to push our SDR as the main global currency and see how that works. But the easiest way to make God laugh is to tell him about your plans and to just assume that things are going to work flawlessly in an environment where people lose confidence in precisely the status quo on a large scale is dangerously foolish, I think. So never before in my career have I had this major sense of urgency and responsibility, ultimately, as I've had when writing The Age of Anomaly, when writing my new book. Because I tell people, when these things happen, you're not going to be able to plead ignorance. Like, should a scenario like this one unfold, nobody's going to knock on your door and say, hey, would it be convenient if this happens now, or should we come back in 6 months when you're prepared, So I would much rather be prepared a year or two too early than a week too soon. And this is kind of why I'm all over YouTube during my big lounge, why I'm on podcast as well, and why I'm spreading the word about these things to, anyone who cares to listen.
Yeah, you've made a lot of good points. I usually don't let a guest go as long as I've just let you go, but you were hitting so many really good points that I thought were critical for folks to understand. Now, one of the things that you mentioned was the stimulus, right? The what we've described it here as with each quantitative easing and all these other types of things. One thing that's interesting about the time frame you just talked about is the accumulation of points of failure, right? That's one item I don't think you brought up, but you kind of alluded to it. And that is, and this has been going on since I started in real estate back in the late 80s. And so we had the savings and loan crash in the late 80s. Then we had the increased level of regulations on banks in terms of limiting their expansion abilities unless they lent more risky loans on purchasing homes. And then that sort of built up. Then we had the .com. With each one of these, you can point to how we have increased the number of points that could fail with each instance. So last time around, we had a lot of things that were, and think of these points of failure as bricks in a foundation. Or the removal of bricks in the foundation is a better way. A point of failure would be a removal of the brick. So things that could potentially cause greater risk the next time. We had relatively few compared to what we have now, I would argue, back in 2006, 2007. We had a lot of things that were in pretty good shape. So if bad things happened, we didn't have as many potential things that could fall as dominoes relating to that. Today, it feels like we have tons more that are at critical points. Here in the U.S., we have a huge pension problem. We have a huge higher education loan bubble. We have a huge automotive loan bubble. We have rules that have been changed on the lending side to basically mimic the policies that were in place before 2007, just on the other side of the coin. So we've made it easier to get a fake high credit score rather than just not worry about a low credit score, which is what we did last time. The thing that concerns me is that last time, and I'd love to hear what you think about this one. So I think if something goes bad this time, you get far more dominoes. I think any one thing can happen, and then a lot of other things can fall as a result. But what concerns me is about the velocity of the stimulus, as you call it, the quantitative easing, the printing of money. So we've talked about velocity before in terms of it being the distance between the creation of the money and it making it into an actual transaction of you buying bread or milk or gasoline or a car. And there was relatively low velocity last time because, as you mentioned, they printed up more money than had ever been around in the 100 years prior. So why didn't we see ridiculous inflation? It was because there wasn't as much velocity. The money tended to go between banks, right? You gave a bank a ton of money, exactly, and then one bank gave it to another bank. So it never went into your pocket to buy your daily stuff. This time, we're in a position where at least some huge chunk of that money is likely to have higher velocity because, as I mentioned before, the things that are bad are very consumer level bad, like a pensioner who needs that check every month or a person who's got a loan on either their education or their car. All of these things spell to me higher velocity, so people can say, wow, we survived the last one with all that money printing, so what's the big deal? I would argue this time we would have higher levels of velocity to that money, which would result in much greater inflation. Am I high, or does that sound reasonable?
It's more than reasonable to be concerned. And actually, I made this very clarification in one of my recent animations on 1 Minute Economics, in that people are asking, hey, all this money got printed. Why didn't we have massive inflation? And I tell them, the Federal Reserve, central banks, they can pump money into the system. But if that money, of course, ends up to a large degree on, as reserves held by the banks at the Fed, then it's not going to be money that ends up in your pockets. And as we move up, like for example, the monetary base went from the 850 billion prior to the Great Recession that I've mentioned to today, which is like 3.8 trillion, down a bit from the 4.1 trillion high of 2014, I think. So from 850 billion to 3.8 trillion, 4.5 times more. But if you look at something, that includes more stuff like the M1, it only went up, quote unquote, it only went up 2.6 times, I think. If you look at it at the M2, it only went up 1.8 times. So
tell folks what the M2 is.
Like, the monetary base is, as you go up, we include more things in what is considered to be money, like, short-term deposits that can be easily converted to cash. So basically, the higher we go up the ladder, they're not tracking M3 anymore, the more things are considered money, and the more money we're talking about, essentially.
So for those of you in the audience who would love a great 1-minute explanation of what he is talking about, go look at the video he posted just 3 days ago titled The Money Supply, Monetary Base, M1 and M2, and you'll get a very quick 1-minute definition of that. So check it out.
Yeah, and it's actually an excellent point, in that eventually that narrative is going to change as well. And for that reason, I am actually worried about inflation, even if we're going to have deflation first. And, since you guys are interested in the real estate dimension, many people ask me what I think about real estate, and they're surprised because I'm not as bearish on real estate as they would expect me to be. And they're like, hey, wait, if you're afraid of a crash, then why aren't you more bearish on real estate? And I tell them, like I told you, that the real thing that I'm afraid of is what comes after the crash. So of course, if you time it perfectly, then by all means, sell before the crash, buy back in after the crash, and then should the narrative change and that loss of confidence occur, which will basically mean that everything that's not status quo tied to the government and the central bank, from real estate to precious metals to whatever, is going to pump up in value quite a bit. So yeah, if you get the timing right, of course, sell before the crash, buy after the crash, and then once control is lost, you're going to have more real estate than you have right now.
Right.
But selling and buying, as someone who does a little bit of business in the real estate sector over here in Romania, it's not as simple as having an online brokerage account and selling stocks. When you sell your real estate, you have to, find a buyer, close the deal. When you buy back in, you have to once again find the seller, close the deal, and you have to make sure you're not, getting scammed, stuck with a bad property and all that stuff. So under these circumstances, to think that you're going to be able to time it perfectly, that's quite courageous. And I'm in the business of giving advice that's applicable, that's actionable. And what I can tell people is that at this point, I'm not interested in liquidating my real estate positions, but I'm not adding anything either. And it all depends on how much confidence you have in your ability to time this thing. If you're that confident, by all means, there's money to be had timing it. But for most people, for the overwhelming majority, I think there are valid reasons to not be as bearish on real estate as people expect me to be.
Okay. Now, a lot of other experts, Peter Schiff is one of them. Peter Schiff is a guy I tend to listen to a lot. But what I'm finding is a lot of folks are echoing his estimation, and I'd love to hear what yours is. The estimation is that the time frame that we're likely to see in terms of a downturn is middle of 2019 all the way through the end of 2020. That's the window, an 18-month a year and a half window where bad things could happen. Are you thinking in the same time frame, or do you think that it might unfold in a different way chronologically?
Well, strictly from a cyclical perspective, yeah, his estimate is as good as any, essentially. So yeah, sure, it all sounds good. But the thing, that makes my perspective different to that of most economists is that I am really big on embracing my incompetence. So whenever we're talking about predicting the future, I'm the first economist to say I am incompetent when it comes to predicting the future.
Sure.
So I choose to embrace my incompetence, one, and two, actually make it a core pillar of my strategy. Because as someone who has invested in so many asset classes and, even newer exotic ones, I've ended up realizing, just how true the adage is that the market can remain irrational for longer than you can remain solvent. So what I try to tell people is to focus less on trying to time it and even less on trying to pinpoint an exact scenario that you think is going to unfold and only try to prepare for that one. In my book, I'm kind of like, look, there are two dimensions. One, of course, let's learn from history. Let's find out what makes us tick. Let's understand human nature. And that's going to enable us actually to position ourselves in a way that maximizes the likelihood that we will spot the next financial crisis as early on as possible.
Yeah.
So that's one. But two, I also tell people, hey, I think about these things. I study these things day in and day out. But I need to have the humility it takes to understand that the next crash, whatever, the black swan event that causes it is, or whatever way in which it unfolds, the next crash might catch me by surprise as well. So I try to focus just as much time and energy on becoming what I consider to be more financially resilient in general, so as to be able to better withstand, everything life throws at us.
Right.
Because one important mistake that, you've mentioned Peter Schiff, when it comes to gold, someone who, let's say, bought a bunch of silver at $50 back in 2011 for all the right reasons, because he realized that, of course, the economy is in trouble, the monetary system is in trouble. So maybe he did his research and bought and said to himself, look, I'm scared. I'm going to sell everything I have aside from the home I live in and buy silver at $50. And he bought it, again, for all the right reasons. And I'm convinced, 100% almost convinced, that eventually the market will prove him right. But sometimes life happens. And if that person, due to a medical emergency or something else, was forced to liquidate his position in silver, let's say 2 years later, then ironically, he protected himself so well that he ended up losing 60% of his money. And this is kind of like the thing I'm trying to focus on. I believe there's just a ton of value in embracing this inability of ours to predict the future. Because when it comes to the person in our example, it's going to matter little to him that eventually, the market will prove him right and silver will end up not at 50 again, but at 100, 200, and so on. It will matter little to him that he was eventually right if he will have had his net worth evaporate in the meantime due to bad money management, due to improper planning, and so on. So I think this kind of humility, it's not nice. It's not pleasant for me as an economist to say this about myself. I cannot predict the future because the number one thing people ask me to do is precisely predict the future. And there's just a huge deal of humility that comes with saying, I don't know. But what I can do is help you become more financially resilient, and so that instead of just focusing on just this one thing that I've mentioned previously, you try to keep it balanced. You have I think that a lot of clarity comes with this humility. And personally, I could think of no better approach to essentially personal finance than having this level of humility, of self-awareness, of saying, look, no, I'm only human. These are my limitations. These tidal waves events, who knows what shape they're going to end up, taking eventually. So I'm just going to try to just do my best to position myself and my family as well as I can, try to land on my feet in a wide range of situations. And there's really not much more you can do than your best in that respect.
No, and I agree with that. You've got to recognize that there's a gap between what I can make an educated guess on and what reality is likely to be, and you hopefully in those margins you minimize what might negatively occur to you. So and I think that's a totally fair statement to make. Now, we've covered a lot of good info here, and I appreciate you being so generous with your time, but I also understand that starting on August 6th, Monday, August 6th, you have some exciting stuff going on, and I wanted to make sure you had a chance to let my audience know what that is.
Yeah, first of all, thanks a lot for the opportunity to do this. My goal with my book, with The Age of Anomaly, is kind of planting seeds in as many minds as possible. Like, I do have this huge privilege of writing books from a position of relative financial security. So The Age of Anomaly is a 400-plus page book. It's huge, but it's conversational. It's not like having this arrogant economist talk to you from his ivory tower, but rather like having a friend who just so happens to be good at economics share some tips with you. And this book, again, 400-plus pages, to kind of generate as much exposure as possible around it, I'm going to reduce the price from the regular one, which is low anyway, it's $10, but I'm going to reduce it all the way to 99 cents so as to give everyone a fair shot of, finding out the message I'm trying to get across at as low as the price as possible. Also, people might want to check out my 1 Minute Economics YouTube channel, because this week, with the help of some very generous sponsors, I'm also organizing a contest around my book promo period. And since we've mentioned crypto, the first prize is actually quite substantial. It's 1 Bitcoin. But even if you don't win that, you can win a bunch of awesome prizes like the second one, which is 1 Ether plus 1 Litecoin, or hardware wallets, or domain plus hosting packages, Amazon gift cards, and just a ton of prizes. And my goal with all of this, and the entire campaign I'm on to spread the word about my work on YouTube, on podcasts, it's all a matter of trying to reach as many people as possible and get them to think.
Yeah.
I don't particularly care. Someone who cares about money is not going to spend time writing a 400-plus page book and then sell it for $1, essentially. But what I tell people is this: if you buy The Age of Anomaly, then great, perfect. I'm grateful for the opportunity of speaking to you in that manner. Or if you subscribe to 1 Minute Economic, once again, thank you. But even if you don't, my only request is this: don't close this browser tab or this application, or however you're tuning into us right now. Don't just close it and move on with your life, because the only victory I want out of this conversation, out of my work in general, is this: if I can get you guys to at least meaningfully think about the things we've discussed today, to meaningfully do your own research, then really that's the only victory I need. So no matter how you choose to do it, by reading my book or by doing your own research, or it's all up to you, I just want to reach as many people as possible and get them to think about these things. Because I've kind of gotten to be known as the economics guy on YouTube. And with this comes, I think, a great deal of responsibility. So in the end, what I'm doing is kind of like this strange combination between altruistic and egoistic, because on the one hand, I want to help people, but on the other hand, I also don't want to feel guilty. So that's
Right.
I don't want to feel guilty for kind of like, reading up on these things, researching these things, articulating these ideas. I don't want to feel guilty after, the inevitable, what I consider to be the inevitable occurs. I don't want to feel guilty that I didn't give it my best shot to spread the word. So essentially, I guess that's pretty much it.
Good. And I think, and the great news is that you, as you're listening to this show, everything he mentioned in terms of the contest, the prizes, the excellent price on his new book, all of those things are happening right now. So you can click this off and head on over to either YouTube, where I'm sure he's going to have a video that gives instructions on what to do next, or is there a URL you've got out there that you could send folks to?
Well, the links to all the places where the books can be found are on ageofanomaly.com, the main domain I use. But they can just, search for the title, The Age of Anomaly, Family on Amazon. It's on Barnes & Noble. It's on iBooks, which is Apple's app, and also on Kobo. So they can just search over there as well.
Excellent. Well, Andrei, I truly appreciate you spending so much of your valuable time with us. Thanks so much. Congratulations on the new book. And let's both hope that we see wonderful economic things for everyone in the future.
Thank you, Robert. Have a great day, guys. And I genuinely hope you were able to extract a ton of value from our conversation today. Thanks again.
You bet, Andrei. Thank you.